Have you ever seen an investment advertising a 47% yield? I mean, it just sounds made up, right? But in the case of Eagle Point Credit Company, or ECC, it was very real, and it's a story that absolutely floored people. So let's break down how on earth this was even possible and, what happened when reality finally came knocking.
All right, so let's just jump right into it. Let's talk about the number that had everyone's head spinning across the financial world.
Yep, you heard that right. A trailing yield of up to 47%. In a world where you're thrilled to get a 5% return, a number like this just feels like it's from another planet. It's the kind of thing that makes you stop what you're doing and ask, wait, what is going on here?
And that really is the million-dollar question, isn't it? Was this some kind of misunderstood income powerhouse, a stroke of financial genius, or was it just a giant flashing red light warning investors to stay away? To figure that out, we've got to pop the hood and see what's really going on.
So to really understand where that jaw-dropping yield came from, we need to get into the weeds a bit and look at ECC's engine. Because, trust me, this is not your typical stock or bond investment.
The absolute heart of ECC strategy is something called a collateralized loan obligation, or CLO for short. Now, I know, it sounds super complex and intimidating, but think of it this way. It's just a big portfolio, a big basket stuffed with hundreds of different corporate loans all bundled together.
The best way to think about a CLO is like a financial lasagna. Seriously, stick with me here. First, you gather up hundreds of corporate loans. That's your base layer. Then, you slice that bundle into different layers, or tranches, each with a different level of risk. The top layers, they're the safest. They get paid back first. But the bottom layers, oh boy, they're the riskiest. An ECC strategy? They go right for that very bottom slice, the equity tranche. It's the last to get paid, but it also has the potential for the highest, most explosive returns.
And this wasn't just some small part of their business. No way. Almost 70% of everything ECC invested in was this high-risk, high-reward CLO equity. This was the supercharged engine, the jet fuel that was driving that massive income stream.
But as you probably know, when you have an engine running on jet fuel, it can be incredibly powerful. But it can also be incredibly dangerous. And for investors, a very harsh reality check was just around the corner. And then, bam, the reality check hit. The company announced a massive cut to its monthly distribution. It got slashed from 14 cents per share all the way down to just 6 cents. So for any investor relying on that income, their cash flow was more than cut in half, pretty much overnight. So why the huge cut? Well, the company's net asset value, or NAV, which is just a fancy way of saying the real-world value of all its holdings per share, was in a complete and